Good afternoon, ladies and gentlemen. Welcome to Market Guru, our special show where we get you to meet the finest cerebral brains on the Lark Street who help you navigate not only the market but also help make money in the easiest possible way, in the most comfortable manner. Our special guest for today is a gentleman who is forever happy, and we are very grateful to have with us Mr. Dinshaw Irani. He's the CEO of Helios Capital India, and among the two happiest men on the Lal Street, with that fabulous smile that always lights up the screen. Dinshaw, Happy New Year, and what a pleasure to welcome you.
Thank you, Shailendra. It's a pleasure to be on your show. And a very happy new year to you, your team, and your viewers. And thank you for this lovely introduction about being happy
Yes.
people.
I've also brought out my finest smile to welcome you, Dinshaw. And the second happiest man on the Lal Street is Dinshaw's partner in investing, which is Mr. Samir Arora. They bring such good cheer, such welcome thoughts on the Lal Street that it's always a pleasure to interact with them. And behind this fabulous smile hides a fabulous investing brain that's been working overtime on Indian capital markets over the last 3 decades. Dinshaw has, along with Mr. Arora, made a comeback on the Lal Street via the mutual fund route and have now started Helios Mutual Fund. Their flagship product, Helios FlexiCap Fund, is 4 months young and is already creating waves on the Lal Street. Dinshaw, how do you see sentiment on the Lal Street at the moment? And what are your thoughts since the first week of Jan 2024 is now over? And we seem to be in a bit of a sideways to corrective band.
So actually, January has not been kind. If you remember, last 5 years, Jan has been negative. So if you want to respect history, then probably you'll see a flattish. I think the best scenario would be a flattish Jan. Uh, Worst case would be a mild correction in Jan. That's how we put it. But having said that, on a longer term basis, India has been on a tear. Actually, it
Yes.
started off in probably 22 itself. And then in 23, you've seen it's one of the best performing markets in the emerging region. In fact, in terms of, so what do you look at in the market, right? If one you look at the valuations, they have to be in sync with the history. Now, if you remember, demon happened in November of 16. And after that only, actually, the real, I think the culture, equity culture caught on as such. And that's why the SIPs moved from some 1,000 odd crores to 17,500 crores now, right? So it's obvious that it's only after demon that the culture caught on. And if you see the average valuations during this period from, say, end of 16 till today, they're around at 20 times, and we're somewhere there. So we're not even stretched on valuations. One thing that I tell all my investors is that if India was a company and that company told you
Yes.
that the growth rates in the future are going to be more exciting than what they were in the past, and obviously in terms of debt equity, we've halved the debt equity as such, and in terms of ROCEs and RONWs, we doubled. You'll obviously re-rate that company, right? And that's what's happening in the case of India. In fact, in the region itself, India, which used to command a premium of 30 odd percent, is now at almost 50 odd percent. And plus, in terms of weights, we almost doubled from what we were earlier, let's say at the beginning of the COVID period, to what we are today. In fact, in the emerging markets, indices, we are at 17 odd percent. So that's the
Okay.
exciting part. I think the flows are pretty good. So we're quite happy.
Absolutely. So let me just present a broad picture about Helios Mutual Fund to our viewers. They have multiple fingers in multiple pies. The first baby in India, Helios FlexiCap Fund, is now 800 crores worth in terms of AUM. Helios, for a very, very long time, has managed an overseas fund focusing on Indian equities based out of Singapore. And that has somewhere like $330 million. And they have been perennial bulls on at least the IT space, the financial services space, and in the recent past, they've also looked at insurance, also looked at the internet space, so on and so forth. So, with that background in mind, uh, Dinshaw, let's begin discussing Helios Flexi Cap Fund. As you see it, 46 stocks over an AUM of about 800 crores, and it's a top heavy fund. The top five stocks, which are HDFC Bank, ICICI Bank, SBI, Larsen and Toubro, and surprise, surprise, HPCL account for something like 27% of the AUM. Dinshaw, what went in your mind and Sameer's mind when you decided this kind of an approach?
So, Sharada, we were very clear that we wanted to give an offering to investors which was not chasing the index. I mean, uh, if you notice, none of the heavyweights are there in our portfolio. There's no Reliance, there's no TCS, there's no Infosys, there's no Lever or any other heavyweight that you can think of in the index. So we were very clear that we want to give an alpha to our investor over that index, and we're not just going to be close to the index and try to say that, okay, market was up X and we were X plus some small basis points. We want to create a regular alpha in this. And that's why we went with what we felt will give that kind of a return. Now, if you notice, banking itself is roughly around 40% of the banking. I'm talking about BFSI as a sector. Is the finance whole of finance gambit as such is roughly around 40% of the weight of the fund as such. And that's like way ahead of what the benchmark offers. Coming to consumption, which is another big play for us, in which we club everything. I mean, we club real estate, tourism, everything as consumption per se. That space itself is around 24, 25 odd percent. So if you see these two sectors, they alone are around two-thirds of that, two-thirds of the weight of the portfolio. And the whole reason why we went overweight in these two sectors is the fact that when per capitas move, and we've seen that in history. Actually, one of the things that we always tell our investors is what we learn from history is we never learn from history, but we try to, right? And that's why if you see these economies which have moved these per capitas this way, it's mainly these two sectors which contribute heavily, consumption and finance, right? And finance, so it's a double whammy for them because it's not only needed to fund the consumption, but also needed to fund the capex which goes into meeting that consumption growth, right? So that's why these two are the heavyweights, and that's why we believe that we need to be heavy on these two sectors. Apart from that, we have quite a healthy mix of, say, infra and utilities, which is needed for a growing economy, right? And plus, we have a healthy mix of, say, outsourcing, which is mainly X of IT, because we're not too comfortable. You mentioned that we were big bulls in IT. That was till 2021. And after that, we've been fairly negative on IT. And we've, in fact, all our portfolios, we run a PMS and AIF also in the domestic market. We've been zero in IT from probably June or July of 22 onwards and never had any IT in our portfolio. So this is how we are trying to give that kind of a return to our investors.
Okay, tomorrow is January 11th, and the first quarterlies from Infosys and TCS start ticking in. Let's see how that bet has played. And Reliance has hit a record high today. It's an absent as far as Helios Flexi Cap is concerned. But that's how life is, and that's how investment decisions are made as far as these roaring bull markets are concerned. Dinshaw, now let's look at the fourth stock in the portfolio, actually the fifth stock in the portfolio. Surprise, surprise, a PSU, and that to an OMC. I love the smile. There has to be a logic that Mr. Arora and you chose something that was, a paria in the markets. कि PSU में पैसे नहीं डालने. आखिर में, 40th fund, 40th stock in a portfolio of 41 stocks could be a PSU. But what has changed? What made you choose a PSU and that to an OMC?
So, okay, first let me just clarify on the fact that you said that Reliance at a one-time high and we still don't have it. But let me tell you, Sharada, the point is that there are probably, if you look at an index, one third of the stocks do phenomenally well in the index. So you have a huge amount of, in fact, for that matter, we had stocks which are like which have gone up multi-fold as compared to what a heavyweight would have given a return. So that way, we're not missing out on anything. Okay? So there's no FOMO. That's what I want to tell you. In terms of HBCL, that just goes to show how flexible we are when we need to get that kind of alpha for an investor. In fact, we can we for a very long time we've been telling you that we need to stay away from PSU. They're not the government interventions are too much and all. But of late, we've seen in at least in the oil and gas sector. In fact, we also have a BPCL, which is somewhere way down the line per se, as you said, that probably the 40th stock in a 41 stock portfolio. That's where it is today. The weight is very low, but we still have it. The fact is that crude, despite all efforts from the OPEC plus countries, has not moved, right? And the government has been also very reluctant, despite the fact that there are these 5 state elections on the way. There's a central election coming around. They didn't go at trying to cut the prices of the retail fuel at the expense of the profits. In fact, now the retailers are the likes of HPCL and BPCL are making hand over fist money on the retail sales as such, which is a healthy indicator that the government is trying to be hands off and really trying to keep it a very free market kind of a play per se. Plus, what excited us more in HPCL itself was the fact that they were looking at demerging. I mean, they are looking at, sorry, not were, they are looking at demerging the crude, sorry, not the lubricants part of the business. Now, that alone, and when we took a call on HPCL, that alone we felt was enough to justify the market cap of HPCL at that point in time. After that, the stock has moved quite a bit as such. But that is what really excited us, and we said we need to be in this counter. BPCL came much later as such. But these are not the only two PSUs. We have a PSU in defense. We have a PSU in utilities. So we've been playing this whole spread depending on where we see growth coming in from looking at the future of our economy.
Okay. And the thing about undervaluation of HPCL, I'd like to point out, even after the stock has, gone up by about 25% over the last 1 month or so, the market cap to sales ratio is, something like 0.13. This is a roaring bull market that we are sitting on. So even now, such fantastic gems are available in terms of potential multi-baggers in Helios FlexiCap's portfolio. Dinshaw, now touching upon the new economy phase, you voted with confidence with the presence of two stocks. One is, of course, a food delivery giant which controls somewhere like 45-50% of India's food delivery market, and of course, one is a payment gateway. Do you think the worst time is behind such stocks? They've had terrible times since they got listed, and now some sanity seems to be prevailing in at least these two.
So basically, I mean, we've been quite verbose about these stocks in our even media interactions. And we've also been very clear that we never bought them when things were looking, I mean, they were like fairly rosy projections earlier on these stocks and the prices had gone through the roof. We waited for some semblance to come into the pricing. We waited for some semblance to come into the valuations before buying them. Having said that, Shailendra, what do you look for? I mean, these are basically all platform companies. They offer you a platform and you're allowed to do whatever on that platform as such. So what do you look for in a platform company? Normally, you look at some 4 odd factors, right? One, that the platform should provide convenience. That convenience should be a mass convenience, and that convenience can be easily encashable, right? So these are the 3 things which have to be ticked as yes. The 4th one, which has to be across, I mean, as to be a no, is the platform easily replicable? So that is what was crossed out for both these guys, which we felt was a very exciting thing. In India, the potential is huge, right? The food delivery player that you talked about. Now, look at it globally. By the way, one more thing that you need to see is that these platforms have to be globally acceptable platforms, as in They've done well abroad, and that's why we brought them back to India. So now, if you look at the food delivery guy, if you look at US, there are only two players, DoorDash, and which has controlled some 60, 70 odd percent market share. And the second one is a marginal, I mean, I think it's Uber Eats as such, which is around 20, 25%. Even going to China, which is probably a developing market, there again, there are only two players. Mituan is number one, and the number two is again a marginal player as such. Even if you look at a Singapore, any other Asian region, there are only two players per country. And that's what excited us about this particular players. India also, there are only two players. Only one of them is listed. And he's gaining market share. And look at the potential. When the company listed, they had only 1 crore odd regular users. The last reported quarter, which was September, they talked about 1.7 crore regular users. That means 70% growth only in the user base. Plus, they've done away with the discounts. In fact, they are now charging premium for faster deliveries. So the potential is huge. Same was the case with the financial services company. I mean, there's so many moving parts within that even if one goes away and basically you can encash every single other moving part in that. And globally also, it's an established model, and potential in India is huge, given the fact that we have something like 40 crore odd base of consumers, actual consumers who really do discretionary spends. So you can imagine that that excitement will always remain, and the growth potential will always remain in these platform companies.
In fact, Dinshaw, there's something that I'd like to share. There were two cash-rich, how should I say, units in India. One was the Mumbai taxiwala. He would always return change to you, unlike Delhi. And of course, the petrol pump guy who would carry this fat wad of cash in his hand. Both have disappeared. And both want you to pay via the digital mode, especially through a payment gateway. And perhaps that's a point towards where things are headed in terms of digital usage. The other thought process I wanted to dig deep with you was when you were setting up this portfolio, apart from the extra alpha that you wish to generate by buying sensible companies across market capitalizations. What is the other thought that comes to your mind in terms of valuations? It's a record high, and we were fortunate to have a fabulous rally in November and December. But does it make task difficult for you and Mr. Arora to try and find companies which even might give multi-bagger returns from such levels?
So actually, what we tell everybody, in fact, everybody asks us, are we value plays? Are we growth plays?
Yes.
We always tell them that we try to get growth at the right value. That is what we want to do, and that is what we want to track on a regular basis. In fact, that's why if you look at our portfolio, our peg is more or less than one price earnings to growth. That is what we try to do is keep it below one as such, and that's why the growth rates are always for us are very sacrosanct. We will not go overboard in giving huge values to a company which is growing at say less than the GDP growth or in line with GDP growth. We would rather try to get. I mean, I'm talking about nominal GDP. That is, our peg is at 11%, right? So what we try to do is we try to ensure that at least in terms of growth, the portfolio as a whole should grow far greater than that. I mean, I'm talking the earnings growth. If you and adjusted for the weightages of our holding within that company, if the earnings growth has to be at a minimum more than that of the index that you're tracking, and that is what I believe will ensure that additional alpha over that index, because ultimately markets are slaves to earnings growth, and that is what we try to get the equation is what we try to get right.
Okay, let me just get this thing out of my way. When you look at your global portfolio, which is the offshore fund set up in Singapore with $330 million, is the Indian FlexiCap fund a mirror image of that? Or are you addressing some different themes for people who invest via the Singapore offshore?
So let me correct you here, Shail. Actually, the offshore fund which invests in India is $200 million, and around
Yes.
$130 million are a overseas fund that we
Okay.
are running as such, which is investing outside of India. So as a group, it is $330 million. So that's how
Okay.
it is. Yeah. In terms of the portfolios, we're very different. They're very different because there'll be certain stocks within our portfolio in the flexi cap. So by the way, that is a much more concentrated fund as compared to what a flexi cap would be. We have around 46, 47 odd stocks. There, I think the bulk of the investments would be limited to around 35, 36 stocks and nothing
Hmm.
beyond that. Obviously, there'll be some overlaps within, but as I said, that in this, in the flexi cap, what we try to capture also is certain newer flavors. Like we have certain MNC stocks which won't be there in our offshore fund.
Hmm.
So certain pharma names which won't be there in our offshore fund. So that is what we try to do out here, and that's why we believe it's a fairly different offering than what our offshore fund is.
Okay. Let's address uh, the elephant in the system, which is the fabulous rally that we've seen in railway stocks and the defense theme. There is a defense play in your portfolio via a government PSU. How do you see railways at this point of time? Hardly does a day go by when two or three stocks don't go up by 5-7%. What's clicking here?
So basically, how we try to play it. So we very gung ho. In fact, during the time of the NFO, both Samir and me traveled a lot by train, and that was
Yes.
a eye-opening experience for both of us because we were like awestruck by the kind of service levels that were there within the train and the kind of normally you associate a train to be uh, crowded and stuff like that. It was a real pleasant trip, I would
Yes.
say, for us, and we did that after a very long time. So it was a total eye opener. So what we decided to do, in fact, we didn't wait for the train journey. By the way, we took up this position much earlier. What we decided to do to play the whole growth in the rail system was through the service provider, which is
Yes.
mainly IRCTC. In fact, it's one of our and by the way, IRCTC is a double play not only on the railways but also on the fact that domestic
E-commerce.
tourism is going to pick up in a big way, and that is why we
Hmm.
believe that that's the stock that we wanted to play it with, and that's what we played it with. We don't like the capital goods suppliers. Uh,
Yes.
Mainly because of the capex heavy model that they run, and obviously the working capital heavy model that they run. So that's why we don't like them much. In terms of defense, again, our call has been fairly different from what the street has been calling out. The street, I think, is more or less looking at indigenization as a big play on defense. But what we believe is, and that's why we got this particular company in our portfolio, which is, in fact, two companies which are there in our portfolio, which are fairly sector, rather service agnostic. They are not limited to, say, one specific service within defense. They can supply across services as such. And that's why I believe they are non-cyclical plays for us as such. And secondly, we also sincerely believe that at some point in time, India will be a sourcing base for defense as such. And in fact, if I'm sure you've seen that playing out also in a way that
Yes.
most of the world, because of the geopolitical tensions, has upped its spends on defense. Be it say Germany, which was the most placid of all, where it was a fraction of its GDP to a percentage plus now of its GDP, and plus obviously China, India, Russia, US, all the major heavyweights are spending more and more. And we believe India will be a perfect base for outsourcing. That's why we identified such companies which could play out on that also.
Okay. The one company that is in the top picks as far as Helios FlexiCap concerned is BEL. I'm trying to find out the other one. Let me just drill down into their stock holdings. We'll take a look at that as well. One thing is interesting, and in our conversations over the last several decades, Dinshaw, I have always found that repeated, how should I say, obeisance that both Mr. Arora and you have paid to India's wonderful technology story. While you could say internet companies are technology plays, and so is the railway theme from IRCTC, but what has changed with you two that this 25, 30-year love affair came to an end?
So, okay, good you asked that question. So basically, in December of 21 is when we started, deciding that we have to cut our weight on IT per se. In fact, our weight at that point in time was some 22, 23 odd
Yes.
percent in IT itself. Talking about. That's when, if you remember, Jerome Powell came and gave a speech to the Senate that they believe that inflation is no more transitionary and is going to be very sticky. And that's when we realized that he will be very aggressive. When bankers go wrong on their calls, they react very aggressively. And we realized that he'll be very aggressive on rate hikes. And if you go back in history, again, as we say that you learn from history a lot, if you go back in history, you will see that whenever these rate cycles pan out, normally the discretionary spends disappear from not only from consumption but also from the order books of various other outsourcing companies, right? And that's where the real margins lie. Right? The rest all
Yes.
are like thin margin businesses. So that's the call we took. In fact, June, July, we were zero of 22, that is. We were zero in IT. And despite now, the scenario is that there'll be rate cuts happening now going forward, right? The point is that our feel is that the rate cuts are going to happen mainly because of the reason that the businesses may start tottering in the US. And as a result, the discretionary spends once again won't come back in a rush. Secondly, the big, I think, bull in the China shop today is now AI. AI itself can play a lot of havoc. In fact, I think the Fed is betting big on AI in the sense that they're looking at efficiencies moving up because of AI. And if that happens, you're talking about IT companies, which are mainly bodies being thrown at the computers. That may take a backseat. So I think there's a lot of upheaval happening here, and that's why we would rather stay back and take a look at what's happening. Frankly, I mean, one of the big, I think, the raw material for IT guys is obviously people, right? And you haven't seen that pickup happening. So we're looking at nuances. We're looking at these kind of things. There's no bench being made up. In fact, contracts are getting cancelled. So
Yes.
scenarios are too good. So we'd rather wait it out. And I think once again the stocks have moved up on some false hopes. It's been happening for a while now, and after every quarter results, the stock come off to that extent. So maybe we'll see that playing out once again.
Okay, tomorrow's the acid test. TCS and Infosys declare. Let's see what happens. But I agree with you completely. In the 25, 27 years, I have watched, quarterly updates of at least Infosys in particular. They've always added people, and then somehow, that's the pause that you see, and it's a dramatic pause, to say the least. Dinshaw, when you sort of look at markets on a daily basis, of course, one feels very happy that the stocks that we've bought are up 5, 7, 10% on a fairly regular basis. Now, this is happening as a part of our daily routine. Some part of the portfolio, rise very well, and that broadens your smile. So does mine. But is there a genuine feeling of missing out on something that you may have wanted to buy earlier, but is now sort of not offering that growth versus value equation?
Oh, lots of times, Shalendra. In fact, Samir and me, by the way, we have a morning call every day, 8:30 in the morning, and I think a bulk of it is spent doing those kind of stocks only. So, but the fact is, as I said, that we never have this fear of missing out, right? We never have a FOMO because we know that there are enough and more in the market which will offer you that growth. So you move on in life. You look at others. You look at whether there's growth happening somewhere. And every day we have an idea which we discuss uh, and analyze as such, and we pass it on to our. In fact, our research team keeps coming up with these ideas as such. In fact, I was telling one of the distributors that despite a rally in the small cap mid cap space, we still have a small cap which is probably at some 14, 15 times her earnings as
Wow.
such, and that's great. So she can, I mean, you can keep looking for it, by the way, and maybe you'll find it at the right point. But anyway, so that's what I said, that we always have this in our hearts, that we have to look at growth. We have to look at stories which offer growth at a value. So that's what we keep
Okay.
digging.
So, Dinshaw, when you look at the last 8 years, you've had successive, consistent year-on-year returns on the Nifty and the Sensex. And now we are heading into what is possibly the biggest asset test for corporate India, for political India, and of course, the Indian voter, the general elections in 2024, April, May, so to say. Uh, when you go to sleep at night, is there that small itch at the back of your mind? What can go wrong? What are we missing? And how can this stump us?
Yeah, actually, it does. It always does, because we've seen that in the past, right? Whenever things look very rosy, something or the other comes up and spoils the whole party as such. Uh, I frankly, if you ask me today, I think it's mainly not going to be India driven. The pause, it more or less would be driven by US. That's what I feel is, because uh, I don't think US again has won the battle over inflation. In fact, the service inflation is a worry out there, still a worry out there, and that's why I think the Fed is being very proactive in announcing the fact that they'll be cutting their rates, and they want that part to come off in a bit. Because if you see today, actually, the yield curve has normalized from 5 year on. Right? It's at
Yes.
4 odd percent of the 5 year yield curve, which is 4 for 10 and 4.2 for. So it's actually normalizing from 5 year on, but at a 4% level. So that's, I think, a worry for Fed, and they still haven't won the battle. So that will be watched very closely. And I think that will be where the pause will happen. A second outlier that we believe can spoil the story, not only for India, but the whole world, is the way the Taiwan and China geopolitical tensions are panning out. That has to be tamped down quite a bit, and if that doesn't happen, you can anything's on the table after that. So.
Okay. With that, then Shaw, sadly, our appointment for today gets over. But what a welcome sight to see you right at the beginning of 2024. And last week we had Samir also on the show. So the next move is to have both of you together and have a fantastic laughing session along with the discussing where to put in money. Thank you so much for your time, and all the best luck for other funds that will come out from Helios' stable. 20 saal baad is when you are back on Indian markets in the form of a mutual fund. And let's hope the second coming is better than the first one, which in fact was fabulous.
Thank you, Shalindra. Thank you for this, and always a pleasure to be on this show. Thank you.
Have a nice day, Dinshaw. That, ladies and gentlemen, was the CEO of Helios Capital India, Mr. Dinshaw Irani. Helios has been coming back to the Indian mutual fund market with the launch of Helios FlexiCap Fund, and that is what we discussed in the show today. We do hope you found this discussion very fruitful. Thank you so much for your time, and remain glued to Business Today for all your financial news needs. Thank you so much. Have a nice day.
Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines, and many other sectors.
In today's rapidly evolving business environment, when risk is omnipresent, managing risks is no longer just about ticking a few boxes. Businesses need to maintain a panoramic view of risks to stay ahead of the curve. Join us to explore how organizations can rethink risk to unlock new possibilities and become fit for future. At PwC presents De-Risking the Future in collaboration with Business Today.
Step into the future at the World Economic Forum at Davos 2024. 5 days of continuous coverage with top Indian and global leaders. Join an exclusive lineup of visionaries, CEOs and policymakers. From dialogues on climate change to economy to artificial intelligence. Experience the transformative conversations at Davos. Business Today Davos, powered by Motwani Jadeja Foundation, conglomerate partner Darwin.
Well, what are the ways to reach Lakshadweep? There are two options, but before that, you should ensure that you are in Kochi, because it's from Kochi where you can travel to Lakshadweep. There's a flight option that